All right, update. What is happening? And this is going to be kind of a serious discussion here, no clowning around. So, stocks are selling off pretty hard, and I'm not going to get into that whole George Soros thing because while that may have created some coattailing, people jumping on his coattails yesterday, there's bigger stuff going on here, or more important stuff that we need to talk about. Yesterday, and I mentioned this, I believe, in a video yesterday, when ECB, when Draghi said they were now buying high yield bonds, junk bonds. So, I've discussed this in the past. The asset purchases have been removing income via that interest channel when the central bank buys government bonds or any other type of interest bearing security. It is taking that interest income out of the economy, out of the hands of savers and investors, and basically transferring it to the balances of the ECB. It's like it goes into a black hole. It's taken away. And what's worse is, in the case of Europe, negative interest rates, and also Japan, it's functionally a tax on deposits. So the tax is imposed to the banks, but the banks try to recoup that through fees or whatever, or they might, charge accounts, your deposit accounts to recover that. So that's like a tax. It doesn't counter inflation. It doesn't stimulate. So this is a fundamental, um, just misconception or policy in the wrong direction from what the intended goal is. Now, yesterday, when the ECB said it was buying high yield, so now bad enough they've taken hundreds of billions in low yield, but at least it was something, taking that away from savers, taking it out of the economy. And now, when they move to high yield, you're stripping out that income, and what they're replacing it with a euro reserve balance, which gets taxed at a negative, which has a negative interest rate on it, so which is taxed. So it's the whole thing is very, very, very deflationary. So and I understood the negative rate implications. I understood the negative rate implications in Japan. The thing is, we have seen higher levels of government spending here in the United States, the largest economy or the second largest economy. We see higher levels of spending in China as a result of its, bank directed or state directed bank lending. It was an offset. We saw commodity prices start to come back this year. We saw the stock market creep back to near highs. And my view has always been that we were on track for more rate increases. And now, if that has been put on hold, if the ECB is buying high yield, the markets now are again pricing in this whole deflation scenario. Now, what the markets price in, that's just people's opinion, okay? We got to remember that nothing really big has changed. We have new high levels, not just new high levels of government spending here, but an acceleration is going on. And yes, while the ECB is buying high yield bonds, the volume of those purchases, to me right now, doesn't seem like enough to offset what we're adding in more government spending here. But it's close. We're not growing at 3-4%. We're growing at 0.8. So all these little things mean something. All right. So right now I'm sitting tight. I have to look at the numbers. The numbers on our side here in the U.S., they look very strong, but it's a global thing. And if the ECB is sucking out money, and if the markets here needed another injection from a rate hike and they're not getting it, this is what's happening. So right now, what do I say? I say we got to watch it. I've been buying this dip on the S&P, and for now we let it run.